All right. Good Thursday afternoon, Finom Group members and our YouTube audience. Welcome back to State of the Market. I am your host, as always, Seth Golden. As you can see, I'm not wearing my Celtics shirt that I wore last week. And most of you know how sad I am. But that's okay. Football season is just around the corner, and my New York Yankees are doing great. Yankees, Boston, like something's wrong there, right? First games I ever watched as a kid, right? Larry Bird, fadeaway three-pointer over Magic Johnson in the quarter, I think it was like 1985. So I was like, that's the team for me. New York Yankees, well, my parents are from New York. I was born in New York, so you're a Yankee fan. Denver Broncos, had that again, first football game I ever watched was John Elway, the drive one against Cleveland Browns, 1986, I think it was, to make it into the Super Bowl. And he drove 99 yards with like 2 minutes to go. And I was like, that's the team for me, right? So basically first games that I ever saw for these sports and or, just being a New Yorker. I actually moved down to Florida when I was 2 years old. Well, I didn't do it. My parents did it. Clearly at 2. Okay, anyways. My attempt at humor there. Well, welcome back, folks, to State of the Market. Hopefully we got some good information here to share with you again this week. Hopefully when we do the screen share this time, it is Thursday, and we know that Thursday has been the worst trading day of the week for the markets in 2022. So hopefully when we go to our shared screen, we're going to see something better on the screen from the major averages. And sorry, here we go. There we are. Well, it's not bright red. The Dow is down, S&P's up 2 points, NASDAQ is the leader. Why is the NASDAQ leading all of a sudden? Well, actually, the NASDAQ 100 have been outperforming a bit here lately with respect to the S&P 500. Stop 1 second, folks. Having some technical difficulties here for whatever reason with my screen share. There we go. All right, this happens every now. I'm on a new Mac also, and I'm alone. I have no parental supervision this week. My family's in North Carolina, so they left me home alone with my dog, Maxwell. So it's just me and Max. I got a little bit more energy than I usually do because I got a lot more space here in the house. I get my office back for a week. A tear. It's enough to make a man cry. Get your office back. So anyways, all right, we got some green to work with here. And as you can see, let's dive right in. Weekly State of the Market. Peak inflation. Are you serious? Maybe. We'll know in hindsight, right? We'll know when it's too late to know, but it's starting to really feel that way. Oh, and I know it's, people have made the claim before as the year has progressed, and all of a sudden we got a new 40-year high in the consumer price index as of the May CPI reading. But there has been more going on here in June. Like, remember when we got the data in June, but it's for the month, the month prior, the May CPI. We won't get the June CPI, of course, until July. So while everybody's so focused on the fact that we made a new high in the CPI for the month of May, but we only got the news here in June, that's well behind us. And there are more material signs that the peak is in the rearview window. I don't want to go out on a ledge here and say it's definitive, but I do have a strong indication, and you never heard this from me before. I have a strong indication that the CPI did peak in May. We are on the verge of rolling over, and it could be a pretty significant reading for the month of June when we get it in the month of July and during earnings season to boot, right? That all lay just ahead of us here, folks, in a couple of weeks. All right, this great quote from Mark Minervini. When you feel like giving up, realize that at the very moment, you are at the same fork in the road that everyone eventually faces. If you quit, you are being just like every other coward who takes the easy way out and chooses to give up. Make the other choice. Choose to persist. Endure. It's hard, I know. It's been a really rough year for investors. It doesn't matter if you're a bond investor or if you're an equity investor. It's been a bad year for you're a crypto investor. It's been that much worse. But the markets have been here before. They've made all-time highs thereafter. Endure, stick with it. You need to persist. You kind of just have to keep your head down and barrel through in order to make it to the other side, those better returns. Stick with your game plan, folks. Stick with your game plan. This too shall pass. We've been here before. We're talking about inflation. We're not talking about a 50-year pandemic. We're not talking about a financial crisis. We're not talking about a 9/11. We're not talking about a dot-com bust that we never had seen before. What we're dealing with today is inflation. We're not dealing with the prospects of which bank do we bail out? Which auto company do we bail out? Can the airline survive? These are not in question. What we're dealing with today is manageable. We just have to manage through these tough times. The market has priced in a great deal, folks, a great deal of pain. You've already experienced it. If you made it this far, ... All right, let's move on. This is every bear market, peak to trough. How many months? About 12 months since 1946. And we've seen other data that says it's about 11 months, peak to trough. It all depends on your starting point and your end point. Some start at 1948, some start at 1946. Some tables will start at 1940, 1932. It's all your starting point. But post-World War II era, 12 months, peak to trough. But how long does it take for you to break even, right? That's what you really want to know. On average, 20 months, 21 months. Could be as few as 3 months, as many as 48 months. But keep in mind, this is buy and hold, not doing anything else, just buying and holding and waiting. That's what your 401k does. If you're an active portfolio manager, I doubt that's very much what you should be doing, is just buying and hold and waiting possibly 48 months to get back to even. No, or nay. If you have cash on the sidelines, folks, you've got a game plan. The S&P's down 22%. The NASDAQ down 32% at its trough. If you don't have a game plan that recognizes the deep value that we're seeing today, oh, but what if we go into a recession? Are we in a recession? Has the market already corrected into bear market territory? Again, a lot of the pain has already been priced in. It doesn't mean we can't go lower. It just means you're getting value. Don't worry about calling the bottoms, the ultimate low. Worry about, are you getting value? And execute. What you don't want to do is just get out of the market, move to cash. A lot of you have seen this type of chart before. Why not decrease my market exposure, right? I mean, the technicals are horrible. Breadth is horrible. The headlines are horrible. Why not just reduce my exposure to the market, take my lumps, take my losses here? Well, if you're a true long-term investor and you do that, you're missing a handful of the best days over long periods of time. And if you miss those best days in the market, which usually come during the worst days of the market, they kind of gravitate to each other because you have this high volatility. your total returns over time greatly reduce. And that's what this chart identifies. The S&P 500 index, 30-year annualized return, almost 9%. Just staying in the market over 30 years, you compound at 9%. But if you miss the 10 best days, your returns go down to 5.75%. Miss the 20 best days, less than 4%. You get the picture, right? You got to stay in the market. You're going to miss, if you get out of the market, you're going to miss at least one of the 10 best days, at least one of the 20 best days, and your return potential goes down. That's why you buy and hold. And if you have cash on the sidelines, you're that much better for it so far as compounding over time. Now recall, and I think a lot of people have, they forget from 1 week to the next, especially when the market is making lower lows consistently, they forget about some of the achievements during this bear market, right? Just 3 weeks ago, we had a 6% gain in the week. That was at the end of May. All right. Right. We made lower lows. Like we gave it up, almost all of it, the very next week. So, I get it. You forget about the good times, right? The pain is more front of mind than the good times. Big weekly gains tend to mark the start to more strength. You can see 3 months later, we're not saying a week later, 2 weeks later, even a month later, but 3 months later, if you've had a greater than 6% weekly gain, the percent positivity rate is almost 74%. In fact, every percent positivity rate is in the 70 to 80 percentile from 3 months to 12 months out. And of course, yes, of course, 2008, you've got red occasions. But just like most of our data, most of the quantitative data that we talked about throughout the course of this year, 2008 has been, they're always outliers. It always shows up as an outlier. Go back to how we started this week's State of the Market. Are we talking about a financial crisis here? It doesn't mean that, 40-year high inflation doesn't kind of offset that and may not produce a similar result as 2008. I'm not saying it won't. I think the probability is very low. Let's put it that way. All right, what else just happened? So we had that 6% weekly rally. Then from early June 8th through June 14th, so 5 trading days, we lost a little more than 10%. It took a week to gain 6%, and in another week, we lost just about 10%. But here's those forward returns. And there's a lot of good sample size here too, folks. 1 week later, usually positive. Let's also keep in mind, all right, aside from this data, the market has been down 10 of the last 11 weeks. In the entire history of the S&P 500, it has not been down 11 of 12 weeks. The odds greatly favor a positive return for the S&P 500 this week. Hence, we had a very good day on Monday. We'll see if those gains can hold up through the remainder of this week. Anyways, 5-day decline of 10% or greater, 90% probability. 1 week later, the market is also positive. 72% probability a month later, 3 months later, 90 percentiles, folks. Indeed, there's your bugaboo, 2008, right? 6 months later, you're still down. 2000, the dot-com bust. 1 year later, you're down. But you are up a week, 1 month, 3 months, 6 months later. So there's, we're seeing some, some outsized moves in the markets on a weekly basis that are telling you there's a lot of conflict. There are investors on one side that believe there's deep value here. And then there's a cohort of investors on the other side that are seemingly stronger at this point, saying, yeah, but the Fed is raising rates. We may go into a recession. Europe will probably be in a recession before us. Look at the high inflation rate. The consumer can't, continue to do this forever. Make any excuse you want in the book, folks. You've got a battle going on here between the investors. All right, moving on. I saw that this is from Strategas, and don't get me wrong, they do great work. In fact, we've highlighted their work here in the State of the Market many times before, but this chart right here, price to earnings ratio at prior bear market bottoms, right? And we're students of data, so we're automatically looking for, well, what's the average, right? I think that's what everybody wants to automatically extrapolate from, the different readings. The price to earnings ratio at bear market bottoms. What jumped out at me was we're all over the freaking place, right? I mean, man, from the highs to the lows and everything, we're all over the place at bear market bottoms. That basically tells me, forget about averages, forget about them. It can happen with any PE ratio. Any PE ratio. I think this is kind of fruitless. The average does happen to be, I think it's 14. 14 is the average. And we got close. I mean, we're at 15.8 times earnings at the market low. That's without any earnings revisions, of course. You have to keep that in mind. Do we want low valuations? Heck yeah. I mean, we'd rather be hitting all-time highs and taking profits, and I get that, but that'll come, right? We just went through 3 years of doing that. We can pause here, and consolidate even your own capital gains and put some more to work, and we'll get the profits later. But in terms of where do you want valuations to be? Well, the lower the valuation, the higher the forward-looking returns. This is a starting CAPE ratio, average forward 10-year S&P 500 annual returns. So, 12-month returns when valuations are at their highest, that's it, 2.7% on average, when the valuations are at their highest. When the valuations are at their lowest, pretty darn good, 15%, 16%. So basically, the higher the valuation, the lower the returns. The lower the valuation, the higher the returns. So yeah, you have to like discounts. You have to like value. History tells us we can expect or anticipate better returns in the future. I had mentioned what's priced in. Well, the reality is nobody knows, but we can look at data, right? Do we know exactly how much the S&P 500 has priced so far as rate hikes? We don't know exactly, but history tells us up to 3 rate hikes, third rate hike, second rate hike, for going back over the rate hike cycles. Here we are, 1958, second rate hike, market was only down 1/3%. So this is the distance from the 2-year high. Look at, folks, we've had a third rate, it's the most in history. We had 3 rate hikes in the past years. We weren't down nearly as much as we are today. So when people say, well, the Fed is still going to be hiking rates, yeah, the market knows that. It's already well ahead of times that we've had 3 rate hikes. 3 rate hikes. The market has priced in a goodly amount. You could make the argument, all of them. What about tightenings? Really, do we want to go down the rabbit hole of what about the Fed's balance sheet? Again, you don't know exactly what's priced in, but we do know this. And so far as the Fed's balance sheet, we only have a sample size of 1 in the past where they've drawn down the balance sheet. They sold assets passively or actively. They have a sample size of 1. How do you expect to price that in? All right. And here's I've looked at this too in the past. And you know, if the year were to end today, you know, if the S&P, if this is the final trading day of the year, we'd be down about 20% in the S&P 500. You know, after 3 rate hikes. Here's all the years going back to 1978 with 4 rate hikes or more. And this is the full year returns. The worst year was 2018. It was down 6%. We are down 20+%, folks. Again, that's just halfway through the year. These are full calendar years with 4 rate hikes or more. Think about the 1980s, how much they had to hike rates. It wasn't 4, it was like 8 rate hikes in a year. And yet, look at the returns. They're far better than today. So yeah, I'd be of the opinion the market has priced in a goodly amount of rate hikes. What else has the market priced in? It's quite possible, because we've heard this all year long. Manufacturing is going to roll over, manufacturing. Now, we never discounted that. We counted on it happening. In fact, it was in our inaugural report for calendar year 2022. Why? Because we were in the 60s in the PMIs, the ISM or the S&P Global Purchasing Manufacturers Index. And keep in mind, folks, these are surveys. It's not hard data. It's just asking people questions. It's gauging their sentiment. So we expected, if you're in the 60s, you're setting a high bar. It's very unlikely that you're going to stay in the 60s. So you have this rate of change, inevitably you're going to draw lower. And that is what has been happening. It hasn't been a material drawdown. It's been very slow. It's been a slow process. We've been hanging out in the high 50s, mid 50s, whether it's the ISM or the S&P Global PMI. But here, if we do a comparison of the S&P 500 stock price and the manufacturing PMI, look, the S&P is in yellow and the manufacturing is in black. And as you can tell, S&P is all the way down here, but the PMI is still in the mid 50s, we'll call it. And they track that, very closely, as you can see over history. The two track pretty darn closely. So when you say, well, we may see, the PMI slip below 50 and go into contraction. Today, we got the S&P Global PMI that was greatly disappointing, dropped all the way to 52. It's a preliminary reading, but still it dropped from like 56 to 52. It's a big drop. The market seems to have priced that in already. The market is down here, which is below the 50 on the PMI. What has the market priced in? In investing, it's kind of, I think Wayne Gretzky put it best, right? He said, you want to skate to where the puck is going. You want to skate to where the puck is going. The market has been going toward possibly contractionary PMI levels, possibly lowered earnings levels, or negatively revised earnings. The market has already been skating to where the puck is going. And these forecasts, as I said last week, don't be surprised if we start getting, the data starts coming in slower and slower. And all of these recessionary calls, which I still don't think are going to come to fruition. But, we get to this dicey part of the economic cycle. It feels like there's a lot of anxiety. It feels like the slowing is magnified, but the market goes higher. Don't be surprised if we get those negatively revised earnings and stocks go higher. Stocks have priced in a great amount of this, of these headlines, if you will, of these foreseeable conditions, if you will, for many, many months now. Don't be surprised. All right. What do we got here? Corporate insider selling. right? We've brought this up a couple times in the past. This is from Sentiment Trader. It's at its lows. And when corporate selling is this low, it's usually, the markings of a trough point in a corrective phase, as it was back here in 2018, as it was back here in 2015, the last time, right? That was the last time in 2015 that we had a recession in manufacturing. Not in the economy, but in manufacturing. Again, 2002, which led to the 2003 rally. And, while we had less than optimistic look at retail sales for the month of May, right? Because we saw a contraction. The month of May, monthly retail sales released from the Census Bureau came in at a negative 0.3%. The expectation was for growth of 0.1%. They weren't looking for much growth. And that was mainly predicated on the fact that the month of April was so strong. So it continued the narrative, kept feeding the narrative that the consumer is slowing, I would emphasize that when the retail sales headline comes out, it's month over month. It's not year over year. And the year over year is the most important. The year over year still came in with growth of 8.1%. Now that is a big slowdown from being in the mid-teens in the first quarter on a year over year basis for retail sales. But again, laws of large numbers, setting the high bar last year. You're not going to repeat that. We grew earnings some 45% last year. Are we going to repeat that this year? No. Set the high bar. It makes it very hard to jump over. You decelerate. All levels of growth decelerate in subsequent years. All right. Oh, I'm sorry. I didn't finish my point here on retail sales. So I did want to interject into our weekly state of the market. This is the high frequency retail sales from Johnson Redbook. This comes out every Tuesday, as some of you are keenly aware of now, and probably look at it every Tuesday yourselves. But you can see this week, it came out on Tuesday, 12.8% year over year retail sales growth based on the Johnson Redbook sample. And that's coming on, we've had 2 months where these were the lowest levels in 2022, 11.4%, 11.4%. What this is telling me though is, and remember, this is from the tax return period. Folks got their tax returns. They really went out and just kind of, last hurrah, if you will. And now we're really normalizing. But, these gaps here tell me they're paying off their credit card bill. That's what these tell me, that this is a responsible consumer. They're, and then when they pay it down, going back out and spending again. I'm good with that, folks. I'm okay with that. So just to look at retail sales, on a weekly basis, it is year over year, but it comes out every week. That's why we call it high frequency data. All right. Let's get down to it. Inflation. Have we rolled over? So for some of you saw this chart in our weekly research report. For our YouTube audience, this is the first time maybe you're seeing it. This comes from a friend of mine, Sean Emery. And you can see rental, right? So one of the reasons why May did have that slight uptick in owner's equivalent rent, it's shown here, but it's still off of the peak. And the expectation is that owner's equivalent rent is going to fall off even further as the year persists. We can see it on a city by city basis here in the chart. These are the most metropolitan areas of the country. And the only ones that are pointing up are San Francisco and New York. Everything else has peaked and rolled over or has been in a downtrend. Minneapolis, San Diego, Los Angeles, Salt Lake City, Miami, Boston, Detroit, all rolled over. I would anticipate, this playing a more favorable role in disinflation going forward. Another metric, fertilizer. Fertilizer is a big agricultural inflationary input here this year, and it looks like that peaked, let's call it early April, and it's been downtrending ever since. Here's another one, lumber, right? Peaked in March, downtrending ever since. Let's take another one, airfare. We know that was a negative contributing factor to the new high for the cycle in CPI for the month of May. But here into June, look what has happened. And all these squiggly lines represent 2018 to 2022. The darker shaded one here is 2022, and you can see it's rolled over in the month of June. And, you know, some people, well, that's because people aren't traveling. We're going to a recession. Recession says what? Not quite. You know, these are the TSA checkpoint travel numbers. Charlie Bilello has been tracking this, and we hit a new post-pandemic high. So you can't tell me that this is because, you know, that we're seeing airfare roll over because there's a lack of travel. Not the case. Not the case. Told you, no adult supervision. So I'm a little while. I've had, I don't know what this is. It was in the fridge. It's got some good kick to it. Caffeine. There's caffeine in here. All right, folks, we're having some fun today. Here's another, right? Used cars. We know that's been a tremendous, you know, negative influence on the elevated CPI overall inflation in 2022. But again, look, we've seen it roll over hard here lately. In fact, we're down 3 months in a row. Down 3 months in a row. What about oil, right? It's the biggest input, right? Energy prices, that's the biggest input. Look what's happened to energy prices. Just early last week, folks. Early last week, we were at $123 a barrel. We're down to 104 and change now. We would want sub $110 to persist with, you know, 7 days left in the month. But this is looking very, very good. Same thing with gasoline prices. We were above $4 on RBOB gas. National average price at the pump, $5. And that's already come back down to $4.75 here just this week. So we have a lot of data suggesting it's very likely that we've seen peak CPI and we're possibly going to roll down. I'm going to say decently. I don't want to say hard at this point, because you know where I'm leaning, right? Jim Cramer on June 6th literally said to buy the dip in oil stocks, stay away from everything else. Ever since then, energy sector ETF is down 18%. ExxonMobil down 16%. Chevron down 18%. He's the expert, right? Since 2001, you know Jim Cramer's service, the actionalertplus.com. So you measure the S&P 500 versus the Action Alert Plus returns ever since 2001. And here's what you get, Action Alert Plus, 229% return. That's not bad, folks. I'm not saying it's bad. I'm just saying it's not even close to what you got for the S&P. Just buying and holding the Spider ETF, you got 420%. Not double, but pretty darn close to double versus what Jim Cramer had to offer. He's the expert, right? Yeah, you guys know how I feel that. You tune into his show. He's, like I said before, incredibly bright guy. But if intelligence was all it took to be a great investor, everybody'd be reading the same reports, everybody be trading the same or investing the same, but it's not. It's not about your IQ, or it's not only about your IQ. It's about your behavior. It's about your emotional quotient, your EQ. Your behavior is going to dictate how well you do as an investor over time. Crude oil, this is from Larry Williams, a couple weeks ago, back in May, I should say. He predicted based on cycles that crude oil would peak at the end of June. It's looking good right now. You want to knock on wood because maybe we could be up next week on some kind of outage, some kind of, headline from OPEC. You just never know. But right now, Larry Williams is looking pretty prescient. Either way, and I've said this many times before, energy is not an investment. Autos are not an investment. Airlines are not an investment. These industries have extremely poor cash flow, energy being one of the worst historically. This chart right here shows you one of the biggest problems if you're an energy investor is that these are the total shares outstanding. Have they gone down, folks? No. In fact, all they've done is gone up since the pandemic. It's creating a lot of supply. And at some point, you have too many shares and not enough demand. And no matter how good the company's performing, most stocks move with the sector ETF. Why? Because the fund flows are mostly ETF flows. They're not stock specific. So you're always battling against the tide when you're investing in energy. Second chart here. Look what the insiders are doing. Insiders selling peaks leads to peaks in the energy sector. And look at what the insiders are doing. They're selling hand over fist. Why are you buying what the insiders are selling? That doesn't make a whole heck of a lot. Now, if it was one specific company, like I get it, and an insider sells for many different reasons, but this is a compilation of the insiders for the entire energy sector. You can't dismiss them all, folks. All right, something else from Larry Williams recently, here in the month of June, the start of a 3-year bull market, which he also believes is going to start at the end of this month. Why? He also sees what's going on cyclically in the institutional buying. Back here, institutions were buying at the trough, into the pandemic bear market. They're doing it again here, folks. The small speculators are not. This is from the COT, the Commitment of Traders report. The small speculators, they're not buying, but the institutions are. And again, the institutions were buying here, the small speculators were selling. Now, we with Larry Williams data or not, we've always known that this is that cyclical part of the year with respect to a 4-year presidential cycle where the 3-year bull market kicks off. And that, again, is what Larry Williams is saying, the start of a 3-year bull market. He knows his odds right here. From July 1st of the second year of a presidential 4-year cycle, which is now, to June 30th of the first year of the next 4-year presidential cycle, so that's 3 years, the average return over that time period is 50%. That's more than 15% compounded a year. NASDAQ, only back to 1986, is 61%. The only 2 times you had a negative return, 1946 to 1949, and during the Great Financial Crisis. That's it. Goes all the way back to 1934, folks. Know your cycles. Cash on the sidelines. Make it happen. That's all I got this week. I hope you enjoyed. Come back next time. Have a great trading week, everybody.